Ever wondered why banks are collapsing left and right? It's time to find out the truth. In this video, we will delve into the reasons behind this financial chaos. Stay tuned as we unveil essential tips from the expert, Rickard, to keep yourself prepared in 2024. Secure your hard-earned money and investments with his valuable advice. When a bank collapses, it means the bank is in big trouble and can't do its job anymore. This happens when the bank loses a lot of money, can't pay what it owes, or goes completely broke. Just like when Signature Bank collapsed, it was because people got scared and took out a ton of money from their accounts after Silicon Valley Bank collapsed. When a bank goes down, it can cause big problems. People might lose the money they had in the bank, and loans might also be affected. And this can create a chain reaction, messing up the whole financial system. The 2023 banking crisis was a really bad situation for banks in the US and Europe. It was the worst crisis since the big financial crisis back in 2007 and 2008. The trouble began because the US Federal Reserve decided to raise interest rates aggressively. These interest rate hikes caused a lot of problems for US banks because they'd invested heavily in government bonds, and when the rates went up, they suffered big losses on those investments. The losses were so severe that people got really scared that some banks might collapse. By the way, if you're finding value in this video, don't miss out on more life-changing content. Make sure to subscribe to this channel and stay updated with our latest videos. Now, this fear caused a lot of customers to take their money out of the banks, which made things even worse. Suddenly, the banks found themselves short of money and facing big problems with getting funds and being able to pay their debts. Sadly, 4 banks couldn't survive all of this pressure and ended up collapsing. Those banks were Silicon Valley Bank, Signature Bank, First Republic Bank, and Credit Suisse. This whole crisis showed how dangerous it can be when interest rates rise too quickly. It exposed hidden weaknesses in the banking system and made everyone realize how important it is to keep a close eye on things to prevent such crises in the future. On March the 10th, there was a major problem in the US banking system. Silicon Valley Bank, known as SVB, collapsed, and it was the biggest bank failure in America since 2008, when Washington Mutual collapsed. The biggest bank failure in the history of America happened during the 2008 fiscal crisis, when a bank called Washington Mutual, or WAMU, collapsed. WAMU was a really big savings and loan association in the US, with over $300 billion in assets and more than 2,000 branches all across the country. A bunch of things went wrong and caused the bank to collapse. They were doing risky stuff with lending money, and then the housing market suddenly crashed, making things even worse. On top of that, lots of people got scared and rushed to take their money out of the bank, which added to the problem. When WAMU couldn't survive all of this, the government stepped in. The Federal Deposit Insurance Corporation, or FDIC, took control of the bank and sold it to another big bank called JP Morgan Chase. Silicon Valley Bank's collapse started when it suffered a massive loss while trying to cash out US government bonds to get money for its depositors. The bank tried to raise money by selling shares, but it didn't work, and that caused a panic that led to its downfall. The collapse of Silicon Valley Bank also had a domino effect on other banks. New York's Signature Bank was the next to close its doors. People got scared after seeing Silicon Valley Bank collapse, so they rushed to withdraw their money from Signature Bank too. As a result, on March the 12th, the FDIC had to shut down Signature Bank to handle the situation. Things got even scarier when Credit Suisse, a major Swiss bank, saw its shares drop dramatically, causing panic in the market. Swiss authorities stepped in on March the 15th to support the bank, but concerns remained about its long-term viability. On March the 16th, First Republic Bank was in serious trouble as its customers also started pulling out their money. In a meeting, the US Treasury Secretary Janet Yellen and Jamie Dimon, the CEO of the biggest American bank, worked on a plan for a private sector rescue. They managed to get a group of American lenders to deposit billions of dollars into First Republic Bank to stop the bleeding. The crisis didn't stop there. On March the 19th, UBS, the largest bank in Switzerland, came to the rescue by agreeing to buy the struggling Credit Suisse in an emergency deal. The goal was to prevent further panic in the financial markets. This whole situation showed how interconnected and fragile the banking system can be. The collapse of one bank had a ripple effect, causing fear and uncertainty among customers and investors, leading to a chain reaction of bank troubles. It also highlighted the importance of having credible plans and safeguards in place to avoid such crises in the future. When a bank fails, it doesn't just affect that one bank. It can cause big problems for the entire economy and financial system. Let's look at some ways it can impact things. Firstly, economic growth can slow or even go backwards. When a bank fails, it messes up the flow of money and investments, which can lead to less money being available for businesses to grow and create new jobs. loans can become harder and more expensive to get. The banks that survive might get scared and start being careful about who they lend money. That means individuals and businesses could find it tougher to get the loans they need to buy houses or invest in their companies. Sometimes smaller banks try to fill the gap left by the failed bank by lending more money. They might step up and offer loans when the bigger banks can't, but it's not always enough to make up for the problems caused by the failure. All of these issues can pile up and lead to a recession. That's when the economy goes through a really tough time. People spend less, jobs can be lost, and businesses struggle. A bank failure is not just a problem for that particular bank. It's a big deal that affects everyone in the economy. A financial crisis and recession can create a perfect storm for economic problems. What are the signs of recession? Diminishing world trade. During a financial crisis and a recession, global trade tends to shrink. Countries might impose trade barriers and tariffs, leading to reduced imports and exports. This decline in international trade can further weaken economies as businesses struggle to find customers abroad and face reduced access to foreign markets. Decline in industrial output. As the economy enters a recession, demand for goods and services usually decreases. Businesses respond by producing less to avoid excess inventory and losses. This decline in industrial output leads to reduced production, job cuts, and potentially even factory closures. It can have a cascading effect on the overall economy, as other industries and sectors are also impacted. High interest rates. In a financial crisis, central banks might raise interest rates to control inflation and stabilize the economy. However, during a recession, high interest rates can be detrimental. They make borrowing more expensive for individuals and businesses, leading to reduced consumer spending and decreased investment in new projects. This in turn can exacerbate the economic slowdown and make it harder for the economy to recover. When these signs converge, it creates a challenging situation for policymakers, businesses, and individuals. Things aren't looking good in the financial world. Some big banks like Silicon Valley Bank, Signature Bank, and First Republic Bank have failed, and Credit Suisse lost a huge $17 billion. Because of all this, Jim thinks there's more trouble ahead, and the US might be heading toward a recession. There are a bunch of reasons why people are worried. There are tensions between different countries, and the energy market is all messed up. Prices keep going up, and interest rates are rising too. All of these things are making investors and economists nervous about a possible recession in the US in 2023. The government is trying to prevent inflation by raising interest rates, but that's also adding to the risk of a recession. The recent bank crisis isn't helping either. The US economy is still growing, but it's growing more slowly now. In the first quarter of 2023, the economy only grew by 1.1%. Nobody knows for sure if the government can manage a smooth landing for the economy this year. The crisis is not only affecting banks, but also the US dollar itself. The dollar is super important because it's the world's reserve currency. But now some countries want to stop using the dollar and use their currencies instead. India is using rupees to buy oil, China is promoting the yuan for global trade, and Russia is already training with the Chinese yuan. Jim thinks this could be a big problem for the US economy. We might run out of money and need to borrow a lot. It looks like this financial panic is just getting started. If you're enjoying this video, like and comment below. Make sure to subscribe to this channel and stay updated with our latest videos. Let's move on. So, how do you prepare yourself against what's coming when you can't stop it from coming? While we can't stop economic downturns from happening, we can take steps to prepare ourselves and preserve our wealth. Economic recessions have occurred throughout history, and they're a normal part of the economic cycle. Instead of panicking, we can make the most of the situation by being proactive and having a well-thought-out plan in place. According to Jim, having a plan is crucial. History has shown that those who prepared in advance always fared better during tough times than those who didn't. By creating a plan and being committed to following it, we can better handle any unexpected events that might come our way. This includes considering the risks and factors that could affect our financial well-being and making strategic decisions about how to position our investments to perform well, even in challenging market situations. In preparation for what's to come, one strategy is to invest in gold. The US Congress has introduced the Gold Standard Restoration Act, which aims to peg the US dollar to a specified weight of gold, potentially making gold a valuable asset to hold during uncertain times. While mutual funds and ETFs can be considered, investing in physical gold bullion is often regarded as the best option for safeguarding wealth. Another approach to navigating the potential economic challenges is to reevaluate your investment portfolio. Consider reducing exposure to volatile stocks and increasing cash holdings. Having more cash on hand can reduce market risk and provide financial flexibility, enabling you to capitalize on potential buying opportunities that may arise during a recession in 2023. As we move forward into 2024, Jim Rickard's top tips for preparation can help you navigate the uncertainties of the financial landscape. From considering investments in gold to adjusting your portfolio to reducing market risks, being prepared is key. If you found this video helpful, don't forget to like, subscribe, and hit the bell notification to stay updated on more valuable insights.